Welcome to The Explainer. Today, we're digging into a pretty wild analysis of a recent dramatic event in the silver market. And let me tell you, it's a story of hidden triggers, absolute tsunamis of capital, and a system that is allegedly under some serious stress. So it all kicked off on December 27th, 2025. The price of silver just exploded. It shot up to a high of $79.57. Now, this wasn't some slow and steady climb. We're talking about a nearly $8 jump in a single day of trading. And look, the source we're examining, they don't mince words about this. They said it wasn't a rally, it was a detonation, a complete fundamental break from how it had been acting, which suggests something really powerful was going on right under the surface. So what in the world is behind a move this explosive? Let's dive right into the signals that, according to this one analysis, point to a truly historic market event and, what it all might mean going forward. Okay, so signal number one, according to this analysis, is all about the timing. This huge move happened during what traders call Ghost Week, that notoriously quiet, low-volume period between Christmas and New Year's when nothing is supposed to happen. Now, you might think, okay, low volume, big price swing, makes sense. But while that holiday lull created the perfect vacuum for a dramatic move, the source argues it was just the environment. It wasn't the real trigger. It was like an empty highway, but something else entirely put the pedal to the metal. So, if it wasn't just a quiet holiday market, what actually lit the fuse? Well, the analysis points to one specific metric that allegedly woke up the sleeping giants of the financial world. And that metric is the gold-to-silver ratio. Now, for you and me, it might just be a chart, but for massive institutional investors, we're talking pension funds, sovereign wealth funds, this isn't just data, it's practically their rule book for how to allocate money. And here's where it gets really interesting. For years, this ratio was way up, over 80 to 1. And at that level, the big money just sees silver as, an industrial metal. But when it crashed below 60, well, that sent a completely different message, a really loud one. According to the source, that sub-60 ratio isn't a friendly suggestion. Nope. It's a mechanical trigger. It literally forces the automated trading systems at these giant funds to start rebalancing their portfolios, moving money out of gold and into what their models are now screaming is critically undervalued silver. The source we're looking at has the perfect name for this. They call it the bat signal, a clear, unmissable sign for the largest pools of capital on the entire planet, who have to follow these strict rules to start buying silver now. And of course, a signal like that has consequences, huge ones. We're talking about a massive wave of new money getting ready to pour into a market that is, by comparison, really small. The analysis actually puts a number on it. They estimate a potential $50 billion wave of capital is now programmed, literally programmed, to flow into the silver market, all because of these automated rebalancing rules at major institutions. And here is the absolute crucial point. It's all about scale. $50 billion? Sure, it's a lot of money. But in the vast ocean of the gold market, it's just a ripple. But the source argues that for the tiny silver market, that's not a ripple. That is a tsunami. Okay, so that's the theory of the money flow. But is there any physical, real-world evidence to back this up? Let's take a look at what the analysis says is actually happening on the ground with the metal itself. Well, first, the analysis points to a huge gap in the price. At the same time New York was trading silver for around $79 an ounce, the price over on the Shanghai Futures Exchange was reportedly over $85. That's a premium of more than $5 an ounce. So why the huge difference? According to the source, that is not normal. A gap like that, one that sticks around, suggests that physical metal is getting super scarce and that the whole arbitrage system that's supposed to keep global prices in line, it's breaking down. And there's more. Over at the COMEX exchange in December, which is supposed to be a quiet month, remember, a record-breaking 12,776 futures contracts stood for physical delivery. They didn't want the cash, they wanted the metal. Let's put that into perspective. This isn't just speculators playing games. The source is adamant that these are serious industrial and strategic buyers demanding the actual physical bars. That demand is for almost 64 million ounces, which is about 8% of the entire planet's yearly supply, all wanted in 1 month. The source frames this in the most dramatic terms possible. This isn't normal market activity. This is a modern-day run on the bank, with investors yanking physical inventory out of the exchange vaults at a pace no one has ever seen before. Now, a stress on supply like this, it doesn't just stay in one little corner of the market, right? The analysis argues that it's bleeding out into the wider financial system, and it's forcing a reaction from the people in charge. In fact, this analysis draws a straight line from all that stress in the silver market to a recent $17 billion emergency liquidity injection by the Federal Reserve. They had to pump that money into the repo market, which is like the critical plumbing of the entire banking system. And this is where it gets really wild. The source claims this intervention creates a dangerous feedback loop, what they call a doom loop. Here's how it supposedly works. The price of silver goes up, which squeezes banks who bet against it. So the Fed prints money to save them. But that devalues the dollar, which just makes the price of silver go up even more. See the loop? So when you put all of these pieces together, the institutional trigger, the drain on physical metal, the central bank reaction, this analysis leads to a forecast for a period of extreme and extremely dangerous volatility. The source predicts these violent price swings are designed to shake out the little guy right before the next major move. They call this the Widowmaker zone. And the theory is that the epic clash between the big institutions coming in to buy and the banks desperately trying to get out of their losing bets is what will create all this chaos. So in the end, this analysis concludes that these signals aren't just pointing to another rally. They're pointing to a fundamental repricing event. And it leaves us all with this final, really provocative question. What happens to a market when the paper promises being traded on an exchange start to completely disconnect from the physical reality on the ground?